All right, we're just gonna get started. This form, if you haven't already filled it out, it's the interest form, which I think all of you guys have figured it out or filled it out because you're here. If you can't get it right now, link's also right there. Yeah, so today's content isn't going to be as concept heavy. We're kind of going to give you guys an overview of what this lecture series is going to be about, an overview of the finance industry as a whole, different career paths that you can take straight out of undergrad, and then also give you some of our own personal tips, some things that we wish we knew when we were going through the application cycle. So again, this lecture is designed for people who have no interest or no knowledge, no knowledge, but strong interest in finance. We're going to cover some topics at a pretty rapid pace to give you a high-level conceptual understanding of what it looks like to actually work at a hedge fund, at a private equity shop, in a structured products environment. What does an interest rate mean? All those other things we're going to try and teach you. So on the interest form, I've asked you guys to fill out a question 1 through 10. How knowledgeable are you about finance? You can kind of see where you fall along this distribution. I'd say anyone on this scale, maybe the exception of the person who put 10, can benefit from this course. You know everything to know about finance. I don't know why you'd be here. But definitely under 6, you're going to get really strong benefits from this course, especially if you come through with every lecture. We're going to be saying a lot of things. There's going to be a lot of lingo and jargon thrown at you. And if you make it through all 7 lectures, I promise you, you'll understand everything that we are saying, and you'll be able to hold your own in a conversation with different professionals. So yeah, this is going to be 7 lectures focused on those non-basic things. So one thing that we kind of thought about when designing this curriculum is we know there's other open education curriculums here at Princeton, and those are great. But what we think is always missing is you can learn accounting and your technical investment banking prep anywhere online. We think the things that we're about to teach you over these 7 courses are things that aren't as readily available online, that you can really only get from working in the industry, having a lot of networking calls, and really trying to absorb as much information as possible. So this is the curriculum roughly, and those are the dates. I'd say put it onto your calendar. Every meeting will take place in this room, tentatively, 8:30 to 9:30, and again, I'll send out all that information on that interest form if you haven't already filled that out. It's going to be a lot to cover. Okay, I'm already going to come out and say that you're probably not going to absorb 100% of the material, but you can learn a lot, and we're going to be giving you guys optional readings, homeworks, and by actually actively participating. And I'll go over what that looks like in a second. And so yeah, why are we doing this curriculum? Why not just help you guys with your technical prep? Well, we think there's a large gap, especially when it comes to informing your future career choice. The best way, the best investors, the best finance professionals, however you want to define that, have a broad overview of how the whole complex machine is interconnected. Because interest rates affects how hedge funds invest, which affects how private equity professionals invest, and you have to really understand this broad picture, which is really hard to do if after undergrad you're put into an analyst position in an investment bank. You will only learn what the investment banking kind of side of things looks like. Also, to help you guys interview better, if you hop into a call with a leveraged finance professional and you're talking about, I don't know, PE leverage going up and private credit facilities having more dominance in the market now, like they're going to say like, oh, wow, this guy or girl, they really know their stuff. That puts you a bit above the rest of the people applying. And yeah, how are we going to do that? Lectures are probably going to be the main way we're going to disseminate content. We have a textbook that we use at TSIG that we've been developing that covers a lot of everything you need to know for technical interview prep. We also have optional readings done by academics covering various topics that we think are really important to understand what happens when things go wrong in the finance world. Marcus Brunemeyer is actually a professor here at Princeton, teaches a class that I'm taking this semester, and this is a really good article about 2008. And then we've also made our own homework assignments. These are, of course, optional. No one's grading them, no one's checking them. But we think that the only way to really learn these things, and this is something that we've kind of learned through TSIG as well, is you really only learn by doing. You're not going to learn accounting by just reading the little textbook of finance. You're going to actually have to work through a couple problems / examples. And that's what those homework assignments are there to give you. Even if you just look at them, you'll get some value. But I'd encourage you guys to open up an Excel workbook, type in a couple things, and really try and absorb the content that way. And then the last thing is, when I talked to a bunch of other people who run investment clubs here at Princeton about what I was trying to do, they all kind of had one concern. They said, okay, yeah, like people are definitely going to sign up. And even now, like we had 150 people sign up on the interest form. Who's actually going to show up? You guys, right? And the problem comes with accountability. We can hold these things. We can put hundreds of hours, which we have, into developing, not hundreds, but dozens of hours of our valuable time into developing this curriculum. And it's only going to benefit you if you actually show up, if you actually engage and ask questions. So ask us, tell us what we can do better, tell us what you guys want to learn about, and we'll make it happen. And as a reward for anyone who raises their hand, participates, asks any questions, we have some candy here. Throwback to 2nd grade. Okay, Yeah, now we're going to launch straight into the content. First, does anyone have any questions about anything I just said? Oh, yeah, sorry, I forgot to introduce ourselves. I'm Sid. I'm a junior studying Orphe, and I'm from Long Island, New York. Sorry.
Hi everyone, my name is George. I'm a junior in the econ department from Beijing.
And I'm Jason. I'm also a junior in the Orphe department, and I'm from Indonesia.
And the reason the three of us know each other is because we were all in Japan together, or he was in Hong Kong, but we were working at the same firm, and we learned a lot of this stuff through our experience at that firm. And that's why when we came back, we think that was a really valuable experience, and the actual content that we learned was the best part of the internship, not actually doing the work, and we wanted to kind of share that experience with you guys. Okay, so the first thing that you kind of need to understand about finance is that it can broadly be divided into two camps. You've got the sell side and you've got the buy side. And as the name would suggest, the sell side is characterized by trying to advise clients and selling them a service or a financial product. And you'd earn money through fees and commissions. So you're trying to be the middle player between a buyer and a seller, a hedge fund and markets, or you're providing some research capabilities. This is probably the most accessible career path straight out of undergrad. At Princeton, you have access to the buy side, but traditionally the path is you go work on the sell side for a few years, and then you transition to the buy side, and we'll go over all of that in a bit. Of course, because it's the most accessible career path, it's extremely competitive, and you guys are lucky you're in a great position going to the #1 university in the world, where you will have access to a lot of these firms. The buy side actually ends up purchasing these financial products, and they earn money through fluctuations in that product's value. So if you buy a stock, whatever you think of as being an investor, you're envisioning someone on the buy side. So any hedge fund role, any venture capital role, any private equity role, that's all on the buy side. So the buy side is more about choosing good investments. Some people say it's like more intellectual work, and you're arguably competing on the most competitive battlefield on the planet, and that is the public equities market. If you're a hedge fund analyst, there's billions of dollars in that market, billions of dollars going to pay really, really smart people with PhDs to build algorithms to beat the market, and you get to play on that battlefield. So some forms of the buy side are stock picking, others are operating businesses, and others are of course working on those algorithms I just mentioned. So after that short overview of sell side versus buy side, there's 6 examples I want to quickly run through and ask you guys where you think it falls. So Maria assists a tech startup in preparing for an initial public offering. And this is the process by which a private company lists their shares on the stock market or on the New York Stock Exchange or on NASDAQ or other markets. Would Maria be a sell side professional or a buy side professional? Yeah, you can raise your hand.
Sell side?
Yeah, what's your name?
Tom.
Tom?
Tom, yeah.
Tom, nice to meet you. You want a Hershey kiss or?
Fine.
You're fine? Okay, cool. 2, David is analyzing the potential catalyst in renewable energy stocks to provide hedge fund clients with more information. Is he a buy side or sell side? Caleb?
Buy side.
Okay, why do you think that?
Because he's helping them, the hedge funds decide which ones to buy into.
Does anyone have any differing opinion?
I mean, it says that his sort of business is selling that information to hedge fund clients. So
Yeah.
he's providing the advising service. It's not fine.
Yeah, so this is a common mix-up. There are 2 forms of sell side or of equity research. There's equity research on the buy side, and that's typically your hedge fund analyst, and then also on the sell side. And of course, we're going to go into all this in more detail. Kevin conducts research on emerging markets to identify undervalued companies for his firm's portfolio. Is Kevin on the buy side or sell side? Yeah.
Buy side?
Yeah, he is. Okay. I'll probably just keep moving to keep things going because I don't want to run out of time. But those are the answers. And well, of course, we're going to go into each of these roles in a bit more detail. Okay, so the first most common form of sell side, when you think of like someone on the sell side, you think of an investment banker. And when you think of an investment banker, you're thinking of an M&A investment banker, which means mergers and acquisitions. So, for example, if Microsoft is a corporation and they're looking to buy 4 of these companies which they actually haven't bought, they're likely to have a lot of questions. They might ask, how much should I pay for each of these companies? Should I use cash or should I issue more shares to buy this company? Is it even a good idea? Am I going to get value from buying these companies? And all the targets, which are the LinkedIn, Activision, Blizzard, the blue ones, they also will have questions. So typically on an M&A transaction, both sides, the target and the acquirer, will have investment bankers on their side, helping them answer all these questions, doing the financial modeling, going through the whole due diligence process. There's another form of investment banking that's a little bit lesser known, called financing. So if Reddit, for example, wanted to IPO, which they did earlier this year, they would go to an equity capital markets team at an investment bank to help them to due diligence process, sell their shares to institutional investors in blocks before they actually IPO, and helping them through the whole process of getting listed on the stock exchange. There's also another side, which is there's a lot more than just these two, by the way. There's like leverage finance and real estate finance and a bunch more financing groups, but these are the two broad buckets. For example, if you're Carrier Global, you're an HVAC corporation in the United States looking to expand into Europe, you want to buy a company there for $20 billion. How are you going to fund that acquisition? So Carrier Global decided to actually issue bonds to fund their acquisition, and they went to a debt capital markets team. And these are usually acronymed to ECM and DCM.
Now that you guys know what investment bankers do, what kind of jobs and what kind of firms are out there for many of you who want to work at these kind of companies. So being at a top school like Princeton, most of you are going to probably want to work at one of these first two types of investment banks. So on the left, you have your bulge bracket firms. These are your truly global firms that everyone has heard of. They work on huge deals, $1 billion plus, and they really touch like all areas of the globe. On the other hand, you also have your elite boutiques. Now, these are like your newer, up and coming, independent advisors. They become really popular recently, especially post 2008. And they also work on these huge billion-dollar deals. So now you might be asking, what is the difference between these two? The main difference is that bulge brackets, they have something called a balance sheet, meaning they're able to lend money to their clients. So as you saw Sid talking about before, investment bankers have two main functions. They have your M&A side and then your financing side. So bulge brackets, because they have a balance sheet, they can actually perform this financing ability in addition to their M&A side. They also often have other forms of businesses beyond investment banking. They often also do things like sales and trading, equity research, corporate banking, all of which we'll get into in a little bit. On the other hand, your elite boutiques, they're kind of specialists who only do advisory. They maybe focus on M&A advisory, but they also do more niche forms of advisory like restructuring advisory and takeover defense. Now, as an analyst, your experience will look a little different whether or not you're at a bulge bracket or at an elite boutique. So at a bulge bracket, your analyst class is typically quite large. It's typically 100 plus, whereas at an elite boutique, your analyst class is between 30 and 70 people. And because of this distinction, at a bulge bracket, the structure tends to be a little bit more hierarchical. As an analyst, you'll either be put into something called a product group or an industry group. And the distinction between these is that a product group is based on the kind of service that these investment bankers supply. So you have your M&A industry group, your ECM and DCM, product groups. Whereas for your industry groups, these are focused on like a specialization on a certain industry, like tech or healthcare or something like that. So for example, in the previous example where Microsoft wanted to buy Activision Blizzard, if they went to a firm like Goldman Sachs to carry out this deal, Activision Blizzard and Microsoft would work in tandem with both Goldman's M&A team in addition to their tech, media, and telecommunication. On the other hand, at an elite boutique, as an analyst, you'll be placed in more of a generalist model where you'll get to touch a lot of different industries and a lot more different kinds of businesses. So for those who are interested in that, the boutiques are probably where you want to be. Now, at both the bulge brackets and the elite boutiques, you'll probably be working very long hours, 80 to 100 hours plus. So for those who are interested in the work, but don't want to make that work-life balance trade-off, there are open to the middle market firms. Now, these are firms which do have a balance sheet, so they can take part in this lending ability, but tend to participate in smaller deals than the elite boutiques and the bulge brackets. Because of this, as an analyst, your experience will likely be a lot more process-oriented rather than based on financial modeling. And you'll likely work maybe around 60 to 70 hours, which is like still bad compared to a lot of other industries, but in investment banking, that's like a very good trade-off. However, the one downside is that unlike the bulge brackets and the elite boutiques, which tend to have more of a consistent analyst experience, being at a middle market, your experience will really kind of depend on which group you're in and which firm specifically. And a lot of the buy-side firms know this, so you'll tend to have like less solid exit opportunities outside of a middle market compared to the former.
Yeah. I'm going to quickly pause for any questions if anyone has. Okay, keep going.
All right. So another major function of investment banks is selling and trading. Now think of investment banks, right? Their main job is connecting buyers and sellers. And this is exactly what sales and trading teams do. You've all probably seen investment banks depicted in movies, right? Think of a million different screens on the trading floor. And so what exactly do they do? Well, to go back to our Microsoft example, they're trying to acquire a bunch of companies, they need to raise debt. So they would go to the investment bank, contact their ECM, DCM teams. Now, though, they have to find buyers of these debt, right? And that's what sell-side traders would, do. And a major bulge bracket investment banks, the sell-side trading teams are typically divided across 4 main buckets. We're going to go through each and single one of them, starting with equities. So on the equities desk, you might be trading like cash equity, so stocks. You also might be trading equity derivatives like futures, options, forwards, etc. Or Delta One trading, other forms of financial derivatives that behave like stocks, and so on and so forth. So the big players in equities are JP Morgan, Morgan Stanley, Goldman Sachs. You can read the slides. Then we're moving on to fixed income. So in fixed income, you could be trading stuff from corporate bonds to interest rates. And there are many other desks in fixed income as well. And typically the big players again are JP Morgan, Bank of America, and Citibank. And then we have commodities. And so, in this group, you might find yourself trading oil and gas, natural resources, or energy trading, which is a newly emerging field that's attracted a lot of attention thanks to the clean energy transition. And lastly, we have foreign exchange, which is arguably the most complex of it all. So, this is the world in which you'll be on a desk trading foreign exchange derivatives, right? Dollar yen or euro dollars, and the swaps, futures, whatever on those products. So you might be wondering, what do people do in sell-side trading? Well, it turns out a lot of them will choose to stay on the sell side, eventually have their own book at a major investment bank that handle millions of trade flow every single day. A lot of them also choose to go to a buy side. So if you happen to be trading, let's say, rates, FX, commodities, you might end up working on a global macro hedge fund. Again, we'll go into what all of these terms mean in more detail later on in the course. So please just bear with us for now. And then to finish it off, if you find yourself trading fixed income, convertible bonds, or equity derivatives at, on sell side, you might end up working for a relative value hedge fund further down the line. And to complete, I guess, the holy trinity of the most popular jobs on the undergrad at investment banks, we have sell-side equity research. So as we alluded to earlier, sell-side ER is very different to buy-side equity research. And you could think of this job as stock picking with several very important caveats. Number one is, unlike investment banking and sell-side trading, equity research doesn't directly generate revenue for the investment banks. So why do they exist? Well, it turns out, providing equity research and maintaining a sell-side network is of immense value to both the investment banks themselves and the institutional clients that they serve. We'll give you some examples here. So starting off with hedge funds, right? A major client of equity research teams. Suppose you run a hedge fund, you want to quickly get, what's the market's opinion on a single stock you're covering? It might be a good idea to get research from Goldman Sachs equity research team or JP Morgan to figure out what their analysts are saying, because they follow these companies in a vertical very, very closely. They also have interface with company C-suite management and know the company from inside out. But these hedge funds won't pay the investment banks for the research. What they will do is direct some of their trading flow to the sell-side trading teams at these investment banks. So it's a business model of doing a favor for some other favor further down the line. And we see this happen on the corporate side too. Let's say Goldman Sachs wants to do business with Microsoft, helping them raise debt in the bond capital market, that DCM market. Well, you can imagine it's not going to help them win over Microsoft if Goldman Sachs equity research team is saying Microsoft is a bad company, you should not invest in it. What this means is oftentimes there's a real conflict of interest issue at investment banks, and there's a real bias towards giving out buy ratings on companies much more readily. And it's been well documented in the financial economics literature that if you follow the advice of equity research analysts, you won't beat the market and will probably end up losing a whole lot more. So why would you want to work at sell-side equity research? Well, it still gives you a very robust training into analyzing financial statements and developing real industry expertise on a particular vertical. And that's really important for when you want to, end up at a long-short equity hot shop further down the line, like Citadel, Millennium, or Point72. And the last thing we'll mention is, if you want to work in equity research, you really got to stop picking and analyzing individual companies. You have to pay attention to the institutional investors ranking. This is a survey that's conducted every year and based on hedge fund feedback on who are the best analysts in this world, and you want to work at a team that's highly ranked in this regard.
And there's a couple other roles, of course, that we haven't explored in depth. Like restructuring groups are really big in investment bank. They're advising companies that are, under financial distress or like bankruptcy or undergoing some major changes, and all the other kind of things that you've probably heard of banking wise. And this is all other jobs on the sell side, and bulge brackets will typically have teams that cover all of this stuff.
Now to motivate our discussion of the buy side, we just want to clarify like what a few terms mean. So many of you will probably have seen like the, your social media influencers, like marketing courses where you can make 100K in a few days. These day traders aren't investors. They do something, what is known as speculating. And speculation is when you seek to generate abnormally high returns through high risk trading. These speculators don't really care about the fundamental performance or valuation of a business. Rather, they just seek to capture like short-term market dislocations through various strategies. What we're more concerned about, and what a lot of buy-side firms are more concerned about, is investing. And this is the process of generating more satisfactory returns. However, they're more concerned about minimizing variance and minimizing the risk. And because of this, these buy-side firms who are investing typically care more about the fundamental performance of the business and take into account a longer time horizon when investing. Now, there are two main types of investing. You have your passive investors who seek to match the returns of the market, and then you have your active investors who seek to beat the market return. Now, passive investors try to match the market by mimicking what is known as an index. And what an index is an area of the market. So many of you here might know something which is known like the S&P 500. This is a list of the biggest 500 companies listed on the US stock exchange that is compiled by a rating agency known as Standard & Poor's. So if you're interested in passive investing and you want to match the US market, you would invest in an index made by some asset manager that replicates the S&P 500. And because this is a lot easier, this is like quite easy to do, to just build a bundle that replicates some kind of market. These firms which take part in passive investing tend to charge very small management fees and no performance fees at all. On the other hand, most hedge funds and private equity funds and a lot of the funds that you might want to work at after you graduate are what are known as active investors. They try to beat the market by individually picking and selling certain stocks that they feel are undervalued or overvalued, whilst also hedging risks by taking predictions of what industries might be negatively impacted in the future and reducing their exposure to those industries. And because this process is a lot more difficult, it requires a lot of data analytics, a lot of computer infrastructure, and spending a lot of money hiring very smart Ivy League graduates. These firms tend to charge a management fee and a performance fee on the amount of money they generate that year.
And just to kind of back up what Jason's saying, this is the trend of inflows and outflows out of actively managed mutual funds, which are open to retail investors, and all of us would be considered retail investors, and into ETFs and mutual funds, which are other passive investment vehicles. And as you can see, the trend's pretty clear. Passive management has been growing a lot in recent years. And speculation has also been kind of growing. I mean, this is average holding period for a stock on the New York Stock Exchange before you buy and sell it. And you can see that it's been trending down. Of course, this isn't like a definitive claim, but you can see that largely the buy and hold Warren Buffett methodology has kind of been going away. Okay, now we're going to move into our discussion of the buy side. So public markets. Does anyone know what, if you want to invest in something right now, what could you buy? Any type of public thing that you could buy. Like if you wanted to buy, I don't know. If you wanted to be an investor right now, what could you buy? Sabrina?
Yeah, you buy shares in India.
Yeah, so you can buy in the finance world, those are called equities because you're buying into the equity portion of a company's balance sheet. So equities is one. Anyone know anything else you could buy? Yeah.
A commodity like a technical.
Wow, perfect. Commodities. So you can buy like actual futures on lithium, oil, copper, gold, wood, tomatoes, like literally anything. These are all like you can trade these. And last thing, there's one other thing that's pretty common in public markets. Yeah, exactly. So this is credit instruments. So government bonds, the US has T-bonds and T-bills. Apple will also issue bonds. And there's also structured products. So if you guys have ever heard of residential mortgage-backed securities. These are also publicly available for a lot of investors, though you probably would be the one to buy any of these products. And so who are the people who actually invest in these markets? You've got mutual funds, like we mentioned. Those are essentially baby versions of hedge funds. They're typically long only on equities, so equity long only, which means that they can only buy a stock. And this is the whole idea of active management. Mutual funds will try and hire someone who's pretty smart to manage a collective investment vehicle. So all of you guys can put $100 into it, and he would manage that on everyone's behalf and buy certain stocks that he thinks are going to be good. And then you have CTAs on the right side, which exclusively invest in commodities. And commodities are kind of an asset class that's hard to understand unless you do it 24/7. There's a lot of momentum. It relies a lot on supply and demand and traditional market forces. So these are typically special firms. And then you have the big kahuna in the middle, the hedge funds, and they kind of exist in all three markets. And they can combine like equities and credit trading to do like capital structure arbitrage, or they can, if they have a view on oil, they can, short oil stocks and buy oil futures and do all these complicated trades. And hedge funds are really like, they kind of dominate the active investing world. Okay, and in private markets, you kind of have the same thing. Instead of equities, though, you have companies because you're buying. It's technically you're still buying into the equity stake of a company, but you can do a leveraged buyout and buy the whole company, whereas you'd have to be a very, very rich investor to do that in the public world. You've also have private credit. So instead of a corporate bond listed on Bloomberg or something, these are negotiated deals between a private credit firm and a specific company to give them a loan. And you also have hard assets here. And hard assets refers to real assets as well. To real physical things like real estate, infrastructure, power plants, solar farms. All those kind of things are also owned by private equity infrastructure firms. And broadly, we'll be focusing more on private equity because that's the most common. Private credit's been on a huge tear these past couple of years, especially out of 2008. And they're a growing market, and we'll cover that a little bit. But to be honest, their methodology is very similar to the private equity methodology, where you're evaluating a company. So you'll get a lot of that exposure to future lectures as well. And the biggest question is where does this money actually come from? And there's broadly three types of investors, and the people who can access these markets, there's only two types. Retail investors, which is pretty much all of us, anyone who's non-sophisticated, that the SEC, which is the Securities and Exchange Commission, doesn't think is smart enough to not be fooled or swindled by a hedge fund investor or a hedge fund general partner. Then you have institutional investors. So this is like Princeton University endowment, pension funds like the California Pension or Public Employee Retirement System, CalPERS. They also have a ton of money and they invest across all these assets. And the last is accredited investors. And the SEC defines accredited investors to be people who make over 200K a year and have $1 million in net worth, excluding their primary residence. So if you're wealthy enough, the SEC kind of says like, okay, you're probably smart enough to not get scammed out of your money. You can invest in all of these vehicles. And so what happens is a lot of factors play into how investors invest. If you are an insurance company and you have a lot of short-term liabilities, you're probably not going to invest in a long-term private equity firm that's going to hold an asset for 10 years, right? Whereas if you're Prinko, you would love that. You'd love to give them $500 million and have them keep it for 8 years and give it back to you because you don't really need that money anytime soon. You have $34 billion, you have people paying tuition, you don't have those short-term liabilities. So all these investors have different investment profiles, which is why this whole wide world kind of exists. And this becomes pretty competitive. If you're not a good hedge fund manager, your hedge fund's not performing well, you're probably not going to raise a new fund and people are going to start pulling money out of your fund. So this whole market becomes pretty competitive. And there's a third group called asset managers that doesn't really fit neatly into my chart, so I put them on the side. These are your BlackRock, Vanguard, Fidelity, really, really huge AUMs. And the reason is, as we mentioned, they have these big ETFs that they manage. So when you actually go to buy the S&P 500, you can't actually buy an index. You buy an ETF that's created to mimic that index performance. And those are managed by all of these asset managers. And they might also have a private equity arm or a hedge fund arm or something that kind of resembles those strategies. But broadly, asset managers are in a separate category. And I'd say you typically would go to that later in your career, I guess, not really out of undergrad. And then list of pension funds. These are some of the largest ones. Japan, because they have a lot of government employees, has the largest AUM, and CalPERS is number 6 over there, and that's one of the largest US investors. And these also dictate a lot of where money goes. Oh yeah, any questions? Okay.
All right. So let's look at an example to make it more concrete. In case you're wondering, this is what Princeton endowment is invested in. So we have the highest endowment per head in the United States, and we've outperformed not just the benchmark, but other institutions like Harvard by quite a bit over the last decade or so. So what's the secret behind our success? Well, if you look at this pie chart, you'll notice a couple of things right off the bat. Firstly, almost half of Princeton's endowment is invested in what we call private investments. So this includes, private equity funds, venture capital funds, real estate, natural resources. So this is this 30% private equity and 18% of real assets. Additionally, Princeton is very heavily invested in hedge funds as well, particularly short biased and event-driven strategies. We'll talk about what these are much later on. But very interestingly, Princeton is not heavily invested in U.S. equities, which has been in the markets generating the highest returns in the traditional realm, forever, basically. So only about 60% of this tiny sliver of 12% of the market is actually in stocks, so like Apple, Nvidia, and whatnot. So this, if you think about kind of who are the investors, what are they investing into? Refer back to this diagram of what Princeton is doing. Think about where in the finance world you might want to fit in after Princeton.
So how do these firms actually make money? So buy-side firms, they generate a fee based off a combination of management fee and performance fee. Your management fees are fees that the buy-side firm charges based on how much assets they're managing, whereas performance fees are based on how much profit they actually generate based on the amount of money they manage. So the typical split is 2% and 20%. So what this kind of means is that let's say you are a buy-side firm managing $1 billion, and then in a particular year, you generate 20% profit. That is 200 million in profit. So your 2% management fee will translate to a $20 million payout based on the $1 billion you managed. And your 20% performance fee on the 200 million will translate to 40 million. So that year you'll make $60 million, which is quite nice.
Well, first you have to manage $1 billion. But
yeah. But a lot of buy-side firms manage way more than $1 billion. So it sounds like a big number, but it's like not that big in the grand scheme of things. But as a particular employee, you're paid through a base plus bonus structure. But as we said before, because you kind of need to be incentivized to actually generate money, your pay is significantly more weighted towards your bonus. Where in good years, your bonus pay could be 4x, 5x, 6x, 7x of your base pay. On the other hand, your sell-side firms generate fees based on commission on the services it provides. So, for example, an M&A investment banker will generate fees based on a percentage of the size of the M&A deal it advised on, or based on the percentage of the size of an equity raise it did or a debt raise it did. Similarly, sell-side employees are also paid under a base plus a bonus structure, but it's more evenly weighted. You'll never kind of find your bonus being 5x of your base.
And buy-side employees, when you said 7x, that's in a really good year. And you will make your base and probably no bonus if your fund loses money. So yeah, it's a lot more volatile, but you have a lot more upside. And sell side is generally pretty steady. Okay.
Yeah, so private equity after Princeton. This is another very popular industry path. A lot of you probably might want to go into afterwards. And similarly with the investment banks, the first way you can kind of differentiate between the private equity firms is based on size. So on the left here, you have what are known as your mega funds. These are your largest private equity firms. They raise funds of $10 billion plus per fund. They have many funds. They operate many different types of strategies, not just core buyout, but they also do credit, they do distress, they do a lot of different things. And they also work on the most complex deals. And so, an example of the kind of complex deals that they can work on is because they're so large and they can invest such large check sizes per investment, they can engage in what is known as a take private. This is when a company buys 100% of a publicly listed company and takes it off the market. A famous example is probably Twitter, but that was done by Elon Musk because he's just very wealthy. But for most people, you kind of have to be one of these huge funds to do something like that. Next, you have your upper middle market funds. These are slightly smaller fund sizes between 5 and 10 billion. They also work on quite complex deals, oftentimes targeting similar types of companies that you'll see the mega funds are targeting. And then finally, you have your middle market firms like Odex here on the very right. These firms are 1 to 5 billion. They do smaller check sizes, and they focus more on volume of deals rather than the size of the deals themselves. And now you might be asking, at least with investment banking, it sounds like bigger is always better. So why would I ever be interested in going to like a middle market fund? Well, a big reason for that is because since middle market funds invest in small companies, these companies tend to be earlier on in a company life cycle. And because of that, a lot of your work as an associate will be more operationally based. So whereas at a mega fund, you'll just be like tapping away on Excel. At a middle market, you might actually be able to like go and meet, the executives of the companies you want. Now, unlike investment banking, because private equity firms are investors, there are many more ways to differentiate them based off of their investment strategy. The first one being the stage of the investment. So on the left, you have firms like Insight Partners, which are VC investors. They invest in very early stage companies with a high potential to 10x year-on-year revenue. A little onwards, you have your growth equity investors like TA Associates. These funds target companies who have a proven business model already, but still have that room to grow very quickly. And then next, you have your very traditional mature company buyout firms like KKR. These funds target companies who are very mature. They have an established revenue, recurring revenue streams, and are generally safe investments. And finally, you have something called distressed investing. These are firms like Centerbridge. They target companies which are struggling, and they bet on their ability to kind of be able to turn around the performance of that company. A very famous one, some of you might or might not be aware of, is Yahoo. So Yahoo used to be like this very big company that kind of went to shit since Google came into. But you had this private equity firm called Apollo who saw Yahoo and saw Yahoo Finance in particular, and saw that Yahoo as a search engine isn't doing the best, but Yahoo Finance is still quite a valuable company, which is where its valuation is being depressed because of the rest of Yahoo's businesses. So what Apollo did is they went in, they bought Yahoo, they deleted the other stuff, isolated Yahoo Finance, and then sold it on for a lot higher. Next, you have your target sector. This is pretty self-explanatory. So oftentimes these private equity firms will try to differentiate themselves from their competitors by focusing on a particular sector. So with Silver Lake, they focus on tech, Al Canton, consumer, and Brookfield Energy. And similarly, you have target geography. So Blackstone is global, CVC is Europe focused, and Temasek is Asia focused. And finally, the last distinction I'd like to make is what kind of value add do these private equity firms hope to add when they buy a company? So you have private equity firms that are mainly focused on improving the business operationally by increasing revenue, cutting costs. These are firms like CDNR. And on the other hand, you have firms which are more concerned with, some would say, artificially increasing the valuation of the company through various forms of financial engineering, whether that be renegotiating credit terms or doing leveraging of the company or doing a wide assortment of things, firms like Apollo. And finally, you have firms which engage in something called platform building, which is where you buy one core company, buy a lot of small companies, integrate that into your core company, and then sell the whole package to a much larger investor for a huge premium. That's firms like Offline.
And like Jason was talking about, there's like a growth cycle of a company. Venture capital is kind of early on. It's like you have seed funding, Series A, B, C, D, and there's a ton of people who do VC. And the methodology there is kind of like, there's no way to really predict which companies are going to succeed. So write small checks to a lot of different companies, and hopefully one of them becomes the next Google. Then you have growth equity. These are companies that already have some traction. They need more capital to expand. Like you mentioned, TA Associates is big in this space. And there's like a whole wide range or a distribution of where people fall along this. Once a company gets pretty large, they can either IPO, list themselves on the public market to access more capital, or they go and get bought out by a larger private equity firm. And sometimes the company is mismanaged, it doesn't do as well as people thought, goes into this distress phase, which is where other private equity firms will try and put out the fire and make it a better company.
So if the apex predator in the private world are private equity funds, their counterparts in the public markets are hedge funds. So we haven't defined what a hedge fund is right now. Turns out it's more tricky than you might think, and we'll have a dedicated lecture on it later on. But for now, the quick and dirty definition is, think of hedge funds as sophisticated, risky, whole investment vehicles for accredited investors and wealthy individuals, right? And these tend to employ the most complex strategies that are typically divided across the product type to deal with, the type of risks they take on, and their trading philosophy. So we're going to run through the CFA Institute's categories of hedge funds very quickly, starting with equity related. So on the left-hand side, we have what's known as a long-short equity strategy or long-short equity funds. These are the quintessential hedge funds. They buy and sell equities. Sounds pretty simple, but very hard to do and beat the market in practice. And so very famous funds include Viking Global Investors and Lopez. These are your notorious tiger funds. And then so these funds can go long and short on the market. And we also have short specialists, the only short companies where dig up companies they think are bad and sell, take a negative view on them. And one short specialist is Hindenburg Research. You might see them in the news. These guys tend to be forensic accountants, and they're very good at spotting accounting fraud and so on and so forth. And then on the right-hand side, kind of go on the opposite end of the spectrum, we have what are known as equity market neutral funds. So let's say as a fund, if you go both long and short, you have exposure on both sides. But if you mix and match those appropriately with certain weights, you can arrive at a position where you're not exposed to any movement in the market. And these strategies are typically all systematic. So there's no individual discretionary stock picking. AQR is an example. They're very well known for doing, building factor models and doing exactly just that. And we won't get into too much detail today. Moving on, another category of a very popular strategy is event-driven. What we mean by events are catalysts that are really crucial to a firm's value. So think of a merger or the opposite of a merger or a distress situation. So on the left-hand side, we have very well-known activist investors like Elliott or Pershing Square. You might not know the fund, but you probably know the man. So Pershing Square is managed and founded by Bill Ackman, famous Harvard alum, has gotten a lot of flame for his views on certain political issues lately. So what do? They play around, major announcements on mergers. They anticipated results, ambushed in and maybe make a profit from it. They also force companies' boards to take changes and make necessary policy that they think will benefit value creation in the long run. And then we also have companies that kind of dabble in the dark arts, distressed investing. In the private world, you're trying to turn this around, and you can also do this in public markets. And one famous firm that does it is Canyon Investors. And moving on, a third kind of broad category is relative value. This is a very complicated world where a lot of PhDs end up, developing really sophisticated models. And we'll classify it very simply for you. So on the left-hand side, we have firms that do fixed income relative value arbitrage. And again, we'll define what it is and explain to it later on. But D.E. Shaw is very good at this. And a fun fact about D.E. Shaw, this is where Jeff Bezos worked at before founding Amazon. So they're really legit. And then you also have firms like DKCM and Capstone that do convertible bond arbitrage or volatility trading. One important point of distinction to make is for those of you that are more quantitatively orientated, you might, be more interested in working on one of these funds because all they do is build models. It's kind of like a black box. You trust the models entirely and base your decisions off that. And then we also have opportunistic hedge funds. It's again a bit of a catch-all term for different funds that come in different shapes and strategies. So on the left-hand side, we have the notorious Bridgewater Associates. They are what's called a global macro fund. So they kind of bet on macro level stuff like interest rates or geopolitical changes and whatnot. So if you're an economics nerd, this will be a good destination for you, perhaps after a stint in consulting trading. And then we also have firms that specialize in very niche strategies like Man AHL based in London. They do managed futures. If you're into CPA, this is probably the number one, and so on and so forth. Lastly, we want to talk about the winners from the past decade. They've dominated the hedge fund space, and they're known as multi-manager hedge funds. So Citadel, Millennium, Point72. They do everything, and by that I really mean everything. Every strategy we covered so far, they will have a specialist team doing exactly just that. And we have a dedicated lecture on them, so we won't say too much. But again, this is probably
Yeah, and one last thing I don't think we covered because they don't actually fit neatly into the hedge fund picture. But quant firms, so if you've heard of Jane Street, Two Sigma, these are all market makers. They're not actually like hedge funds in the classic sense. So they're very quantitatively driven. And yeah, I'd say that they aren't typically classified as the buy side. Yeah, they kind of exist in their own world. If you're really into quant and like doing quick math and probability and trading, that's the job for you.
So for you, any of you who've spent some time, looking at this industry, you might come across this career trajectory, which a lot of people consider like the ideal of what you want to do. We just want to highlight that we've spoken to a lot of very successful investment bankers. So we just want to reiterate that just because this is what a lot of people say you should do, doesn't mean you should follow this path blindly. Kind of take the road less traveled. Do your own thing. So.
Yeah, and this is if you've ever been on the Wall Street Oasis, which is like the Reddit for anyone in the finance world, you'll often hear 2 + 2 + 2. That's 2 years in banking, 2 years in private equity, 2 years in business school, and then hopefully you pray you make it to a single manager tiger cub. And the reason they're called tiger cubs is because there's this really famous hedge fund manager named Julian Robertson who had a hedge fund called Tiger Management. And when he closed down the fund, he took a lot of his own money and seeded, and we'll go over hedge fund seeding and how that whole process works as well, and seeded a bunch of these smaller, some of his own employees, and they started their own very successful hedge funds. And I guess that's like the paradise of the finance world. And again, I want to emphasize there's a lot of like offshoots from this. From banking, you can go work in corporate finance. From private equity, you can drop in and be the CEO of a company. There's a lot of different routes. This is like the golden route, as people will say. Again, that's not really true. Okay, now we're gonna move into some more like tips on like how to actually get these jobs. If you're a sophomore, very relevant to you. If you're a junior, senior, or a freshman, you have a different. We'll still cover that. The unfortunate truth is that GPA and networking matter. Frankly, I never really focused on my GPA or on networking, and I got lucky. I'd say the people I know who like really did get like through the whole process very smoothly. They had high GPAs, they get filtered pretty quickly, and they networked a lot. And so this is like for junior summer. If you're a sophomore, for your junior summer, which is next summer, this is roughly what the timeline looks like. Of course, it varies a lot firm by firm. Every year it gets pushed earlier and earlier. If you read like a blog post from 5 years ago telling you that applications will open your sophomore summer, they are wrong. They will all be closed by your sophomore summer. September and October is where you are right now. You want to start lightly networking, maybe figure out what you want. Do you want to go really hard onto investment banking, private equity, or a hedge fund? Honestly, apply to everything. It never really hurts. It's really all a numbers game. Make sure you understand the different roles. Talk to your upperclassmen friends. Ask them, why did you choose to go through consulting, or why did you choose to go to, I don't know, Goldman Sachs, and like try and learn more about their decision process. In November and December, you should start preparing all of your materials. So your resume, your cover letter templates, grind your technical questions. There's a ton of free resources online that we'll also share with you. You should know every question like the back of your hand, because if you are lucky enough to get an interview, it is all on you. Do not forget your technicals. Do not forget your behaviorals. You should know all that stuff like the back of your hand. And this is where your network should really be ramping up. In January, this is when applications will really start to open. Apply to literally everything, even roles you don't think you will ever want, because once you get one offer, you can accelerate your processes at a lot of different firms. So you should apply everywhere, find some friends. This is something that I don't understand why people don't do, but I mean, yeah, everyone has friends, but find some friends who are also doing finance recruiting, because it makes the whole process earlier. People will text you like, hey, did you apply to this? This just opened up. They'll help you do mock interviews. They'll tell you like, oh, I spoke to this person at Centerview. You should talk to them too. All of this other kind of stuff. Getting the interviews, honestly, I think the hardest part, because there's literally just, I think Goldman had like 360,000 applicants for 2,000 jobs or something like ridiculous like that. So literally just getting the interview is really hard. You'll typically get these things called hire views, which are really annoying and frustrating, but they're just like you record yourself talking to a camera, and then hopefully someone watches it. Maybe it's an AI that watches it. I don't really know. February and March, it's kind of when all the applications you've submitted, hopefully some interviews are rolling in. You should be prepping everything, your behaviorals, your technicals, doing a mock interview, asking yourself a question every day. Me and my sophomore year roommate, every morning in the bathroom when we brush our teeth, we quiz each other on technicals, ask him like, what's the difference between equity value and enterprise value? And it's just a good way to like keep your mind sharp. Every interview you get, you should know the back of your hand, why you want to work at that firm, what does that firm actually do, know your behaviors, know your technicals. Like, I can't emphasize that enough, because once you get the interview, it's literally all on you. You've gotten past the hardest part. If you mess it up, you mess it up. And hopefully by March, April, you have your offer, you're checked with it, you can kind of chill out. If you're interested in consulting, quant, tech, suite, other boutiques, Some jobs will remain open over that summer and into your junior year. And don't slack off too much. Like if you have maintained a high GPA, try and keep it high, because just in case you don't get the return offer and you need to do full-time recruiting, that stuff will start to matter again. There's also this thing called Tracker, and I tried to find the one for the 2026 cycle, but I don't think it's created yet. This is the one from our cycle. And essentially it's just a list. It's like a 200-line list of like every firm in finance, essentially. Some firms aren't on here, but they'll post when the jobs open. You should be checking this every morning once you get back to Princeton in February, and applying to things as they open, as soon as they open. For freshmen and your sophomore year summer, you should still try and find an internship. I think experience always helps, even if it doesn't end up on your resume. It's still important. You can find jobs by cold emailing smaller firms, especially if they have Princeton alumni. One of my roommates, he just literally cold emailed 20 firms in New York City and ended up working at a pretty big hedge fund just because they had a spot. Stalk LinkedIn. So if you have upperclassmen friends, go onto their LinkedIn, see where they work their freshman and sophomore year summer, and try and ask them if they can help you out get a job there. My take is you've got your life to kind of grind a finance job and become immersed in the finance world. Have some fun. I think the International Internship Program at Princeton, if you're unfamiliar with it, is one of the best things that Princeton can offer. You get to go abroad with a bunch of other Princeton people and do a cool job and have a ton of fun. And if you're underrepresented or a minority, apply to every single diversity program you can. You should go and network with people. More context never hurts. Those are always great to go to as well. Resume advice: do not use a fancy template with your photo on it. Use a standard template. I've linked one in this PowerPoint that you guys will get after. A couple don't rank your skills. Like, what does it mean that you're an 8 out of 10 on, I don't know, finance? Like, you should ideally be a 10 out of 10, and why are you ranking it? What does that even mean? I don't know. Don't put anything you don't know about. One of my friends had American football and one of his interests, and first thing the guy asked him on the interview, he's like, "Oh, what's your favorite football team?" He does not watch football. He doesn't even know a football team. So it's just a really bad way of talking about things. Yeah. If you need help, the Career Center has peer career advisors. Those are really, really useful. They know what a resume should look like, and they'll help you reformat your bullet points into something that actually means something. Include numbers, even if you have to like guesstimate them. You should be able to say like, oh, if you're the officer of some club, that's a 50% increase in attendance over 10 meetings. Like, quantify things a little bit. And yeah, you will be asked in every interview about something on your resume. So make sure you have a comprehensive story of what you did at the internship, why you chose that job, what you learned from it, what your supervisor would say about you. And again, all those kind of behavioral questions we've compiled and we'll send to you as well. Networking, I'm going to start with a don't, because this is just honestly, I'm embarrassed to share this with you guys, but hopefully it helps you realize that nothing is ever really that deep. I thought I was smarter than everyone. I was like, everyone's writing these manual emails. Like, why am I going to waste my time doing that? So I asked ChatGPT to generate some code to send out emails. And ChatGPT is pretty good. It's not great. And to William Blair, which is an investment bank, I believe. In the +1, somehow it sent 2039 internship applications. So I guess that was a heap more time.
Did you get the job?
It's safe to say no job, no response, nothing.
Big approach though. Getting 5 years in advance.
Yeah, maybe. They honestly probably weren't impressed. Also, a couple other notes, don't send the same exact email to the same people at the same firm. These firms aren't that big, like they're big, but not huge. They will be saying like, everyone's computer will ping at the same time. They'll all know they got a networking email from some Princeton student at the same time. If your friend is networking with someone and they say, oh, they responded, give it a couple days, also email them. Chances are they probably know people, and you should also be able to ping pong between people. So if you talk to, I don't know, like a warm connection who's like friendly with you, you should say like, hey, do you know anyone else in this world that I could talk to? And they will probably refer you to a couple people, and it's a good way to meet people. Yeah. Are there any international students here, by the way? If you're international, raise your hand. Okay, good. Yeah.
Oh, wow, that's quite.
Yeah.
First of all, if you're international, I'm so sorry. The process is gonna be more difficult for you, but you can still do it. The first thing, please make sure that the bank actually sponsors. So I networked with maybe 8 people from Guggenheim. I sent in my application, and 1 second after I sent it, I got the rejection email. Turns out they don't sponsor me, so there was never a chance in the first place. So these 3 banks kind of sponsor every year. Most banks either don't sponsor at all or case by case, and what that means is that you're kind of put to a higher standard. The list changes every year. The best thing you can do is if you're on a networking call with somebody who you know is international, go and ask them, and they should be very helpful. And another thing, to turn your downside into a strength, please network with other internationals. So I'm Indonesian, and there's a grand total of 3 Indonesians working at investment banks in Wall Street right now. At least at the analyst level. I think after that, we all go back home or something. Anyways, so typically your networking emails will have about a 20% from Princeton, we're pretty good. It's like 20% hit rate. So like which is not bad. For my 3 Indonesians here, I got 100% of them to respond, as you see on the left here. So if you're coming from some like niche country or exotic or whatever, just send it out, include that you're from there in the thing, and they should respond, and they'll help you out.
As a final point, for those of you that are international, just remember, job searching won't be easy just because we go to Princeton. That's the fallacy I had to come across in my freshman year very quickly. The acceptance rate, if it's for the thing at Goldman Sachs, is about 1/10 of Princeton's acceptance rate. And you'll be competing with kids that are very well motivated. So know your stuff, start early, and do the little things right. Network as much as you can.
Yeah. Okay, couple of tips, because there's a ton of resources online in recruiting. I linked 2 guides that I think are pretty useful. And that one already has an outdated timeline. It's probably only posted a few years ago. But again, this stuff keeps getting earlier and earlier. Find friends. That's probably the biggest advice I can tell you. A lot of people treat this as a zero-sum game where they say, oh, why would I tell my friends about this job? Because I don't want them to get the job and not me. I'm actually going to work at a firm next summer with 2 of my best friends who I told about the job after I got my first round interview. And now we all get to work together. It's going to be happy. But comparison is also the thief of joy. Don't compare yourself to anyone else. You never know why someone got a job. Maybe their dad is the head of investment banking at a big bulge bracket. You really don't know. Something I like to do is whenever someone gets a job, I take their last name and the firm and I put it in Google and see what comes up. You really don't know what's happening on the back end. Just focus on yourself, compare, just get like really sharp on your own stuff. You will be fine wherever you go. There's, especially at Princeton, especially at top universities, there's a big culture of, why would you ever go to work at a middle market investment bank or a middle market private equity place? Like, I'm only going to go for a mega fund. Like, there's this hierarchy, this is ranked. On Wall Street Oasis, you can find hundreds of rankings that people put together. None of the stuff really matters. You're literally 20 years old, and you're thinking that the rest of your career, the rest of your 50 years, 30 years in the industry are going to be based on where you went to work out of undergrad, or really where you did your summer internship. In the grand scheme of things, none of that stuff matters. None of that stuff matters. You can make a lot more happen with whatever cards you're dealt. Also, I think a lot of people make this mistake is they think first year comp is the most important thing in the world. It's a drop in the bucket compared to whatever else you'll be making in the future. Even if there's a job that's paying you double, and there's a job that you just like more, you think you're going to learn more, you're going to have a better opportunity there, choose the job with that better opportunity because you will thank yourself for that experience. Again, these resources will be sent out to you guys as well. Okay, any questions? Really? I guess we did that good of a job. If you guys please can all fill out this survey because I have to tell the Bentham Center how many people were here, how we did. You have an opportunity to leave feedback there and also give us a rating 1 out of 10 if we helped you. And yeah. Also, if anyone wants Hershey Kisses or Dum Dums, they're up here for you guys to take.